Hey everyone, and welcome back to the channel. Today we're diving deep into the world of Singapore's real estate investment trust, specifically focusing on a big player in the industrial and logistics space, ESR-REIT. You might have heard of it, or perhaps you're wondering if it's a smart addition to your investment portfolio. In this video, we're going to break down ESR-REIT current financial health, its growth prospects, what risks you should be aware of, and critically, what the market is saying about it. By the end, you'll have a much clearer picture to decide if this REIT is a buy now, wait, or don't consider at all for your investment journey. Let's get started. If you haven't already subscribed to our channel, please subscribe to our channel. Your support truly makes a difference, enabling us to produce more stock and fundamental analysis content. But first, a quick disclaimer. Please note that the content presented in this video is for informational purposes only and does not constitute investment advice. We strongly recommend that you seek proper guidance from a qualified financial advisor before making any investment decisions. First, let's talk numbers. Think of this as checking ESR-REIT financial heartbeat. We'll look at two key periods, the full year of 2024 and the most recent first quarter of 2025. For the full year 2024, ESR-REIT faced some headwinds. Its gross revenue and net property income, or NPI, saw a slight dip of around 4% year-on-year. More notably, its distributable income and, consequently, its distribution per unit, or DPU, which is what shareholders receive, fell by about 15% and 17% respectively. They also reported a net loss after tax of about 107 million Singapore dollars. Its gearing, or debt level, stood at 42.8%, nearing the regulatory limit, and its interest coverage ratio was 2.5 times. This period reflects a challenging environment. However, fast forward to the first quarter of 2025, and we see a much more optimistic picture. Gross revenue surged by over 24%, and NPI jumped by more than 31% year-on-year. Distributable income also saw a healthy 7% increase. Their gearing improved slightly to 41.9%, and importantly, over 81% of their interest rates are fixed, which is great for stability in a rising rate environment. Their weighted average debt expiry, or WAID, is 2.8 years, meaning their debt is spread out, reducing immediate refinancing risks. So while 2024 was tough, the latest quarter shows a strong rebound, indicating their strategies are starting to pay off. Now, let's look at what ESR-REIT has been up to and where they're aiming to grow. REITs don't just sit still, they're constantly optimizing their portfolio. In late 2024, ESR-REIT made some strategic acquisitions, picking up new properties in Japan and expanding their presence in Singapore. They also divested or sold off some non-core assets in Australia and Singapore, which is a smart move to refine their portfolio. Early in 2025, they underwent a unit consolidation and even conducted unit buybacks, often a sign that management believes their units are undervalued. Plus, they changed their name from S-REIT REIT back to just ESR-REIT, streamlining their brand. Their growth strategy is centered around what they call the For Us strategy. Rejuvenation, this means upgrading older properties. They've completed significant asset enhancement initiatives, or AEIs, on properties like 7002 in Mokoro Avenue 5, boosting their value and rental income. More AEIs are underway, and they even have a proposed redevelopment for a new cold storage facility at 2 Fishery Port Road. Recycling, this is about buying and selling assets strategically to improve portfolio quality. Recapitalizing, strengthening their balance sheet and managing debt effectively. Reinforcing sponsor support, leveraging their strong sponsor ESR Group for potential new assets. They're also heavily focused on increasing their exposure to new economy assets like modern logistics facilities and data centers, which now make up over 70% of their portfolio. This positions them well for future demand driven by e-commerce and digitalization. Their portfolio land lease has also been extended to a healthy average of 43.7 years, providing long-term stability. No investment comes without risks, and ESR-REIT is no exception. It's crucial to understand these before making a decision. Firstly, despite the Q1 rebound, the net loss in FY 2024 is a significant point. It reflects challenges that could re-emerge. Secondly, their gearing at around 42% is on the higher side, though still within regulatory limits. This means they have less room to take on more debt for future growth without potentially raising equity. While most of their interest rates are fixed, any substantial and prolonged increase in borrowing costs could still impact their distributable income when debt needs refinancing. Thirdly, while overall occupancy is healthy at 91.6% in Q1 2025, occupancy rates in some specific properties have declined. This points to potential challenges in certain submarkets or property types. Finally, the competitive landscape in Singapore's industrial property market is intense, with many other strong REITs vying for tenants. Economic slowdowns could also put pressure on rental rates. One specific risk factor is their lease expiry profile. While their weighted average lease expiry, or WALE, is a healthy 4.1 years, about 3% of their leases expire in 2025 and 17.4% in 2026. This means they need to successfully renew or lease a significant portion of their portfolio in the next couple of years. Good news is, passing rents are generally below market rents, which provides room for positive rental reversions upon renewal. So, what do the experts in the market think about ESR-REIT? The general market sentiment is quite positive. Most analysts who cover ESR-REIT have a buy or outperform rating, with target prices typically ranging from 32 cents to 39 cents. DBS, a prominent bank, even calls it a tactical pick. Why the optimism? One big reason is its dividend yield. ESR-REIT currently boasts a compelling dividend yield of around 9.8%, which is significantly higher than many of its peers like Mapletree Logistics Trust or Capital, and S-REIT, which typically offer yields around 5.8%. This higher yield makes it attractive to income-focused investors. However, it's worth noting that its higher gearing is also a factor. Despite this, ESR-REIT is currently trading below its historical averages in terms of price to net asset value and yield spreads, suggesting it might be undervalued relative to its own past performance and perhaps in some peers. The recent unit consolidation, which essentially combines multiple units into one, was also done with the aim of improving market perception and making the stock more appealing to a broader investor base by reducing price volatility. Alright, so after all that analysis, the million-dollar question: should you buy ESR-REIT now, wait, or avoid it altogether? ESR-REIT presents a compelling case for income investors, especially given its high dividend yield of nearly 10% and the positive turnaround seen in Q1 2025. The management's 4A strategy, focusing on high-growth new economy assets and proactive debt management, is showing promising results. The discounted valuation compared to historical averages also suggests potential upside. However, the high gearing and the net loss in FY 2024 are factors to monitor closely. While Q1 2025 was strong, sustained performance is key. Consider a buy if you're an income-focused investor with a medium to long-term horizon and you're comfortable with a slightly higher risk tolerance given the gearing. ESR-REIT could be an attractive tactical pick. The high yield offers a significant return and the growth initiatives appear to be gaining traction. Wait, If you're highly risk-averse or prefer to see a longer track record of consistent growth and lower gearing post-2024, waiting for another quarter or two of strong results might be prudent. Don't consider this would be primarily for those who are strictly against REITs with higher debt levels or who are very concerned about the industrial property market outlook. Ultimately, remember to do your own due diligence and consider your personal financial goals and risk tolerance. Again, this video is for informational purposes only and should not be considered financial advice. Please consult with a qualified financial professional before making any investment decisions. What are your thoughts on ESR-REIT? Let me know in the comments below. If you found this video helpful, please hit that like button, subscribe for more in-depth analyses, and ring the notification bell so you don't miss our next video. Thanks for watching, and I'll see you next time.